Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Well, today we're talking about something I think is extremely timely. We're talking about federal bonds and U.S. government bonds in particular. We're here with Joseph Wang. Joseph is the principal at Monetary Macro, which is a registered investment advisor. He writes weekly for a newsletter called fedguy.com, which I suggest check out. And he's the author of a book called Central Banking 101, which you can get on Amazon. Do check that out. Previously, Joseph was a senior trader on the Federal Reserve's open markets desk. He got his BA from Northwestern University and his JD at Columbia Law School and a master's from Oxford University. So, welcome to the podcast, Joseph.
Well, thanks so much for having me. It's a pleasure to be here. And I have to confess, I actually failed level 2 of the CFA. So if any of you are struggling with the test, there's still hope for you.
Okay, that is super well timed because the level 2 test is in 2 months, just about from today. Well, great. So let's talk about U.S. government bonds for a second because there's an awful lot going on right now. So what's your current view of U.S. government bonds, long and short?
So when I think about rates, I think it's mostly about the expected path of Fed policy plus supply and demand dynamics. Now, looking at both of these factors, I'm focusing on the 10-year yield, is a bit too high. So I think the market is both too hawkish in their perception of the Fed, and also they're not taking into account some of the big regulatory changes coming down the pipeline that are going to have big impacts on the supply and demand dynamics of treasuries. Now, focusing first on the expected path of Fed policy, we just had the Fed meeting for March yesterday, and you can see from the dot plot, the Fed is basically frozen in place, keeping their penciling 2 cuts this year the same as December. But looking deeper in their forecast, you can see that they have a more downbeat assessment of the economy and a more upward risk for inflation. So there's a lot of uncertainty right now when it comes to policy. Chair Powell noted changes in trade, changes in fiscal policy, changes in regulatory policy, changes in immigration, and so forth. But I think what would happen now, and I'm looking at 2018 as my template, is that financial disruptions are probably going to supersede all of this. Now, all these real economy changes that are happening through policy are very significant, but the markets are much more sensitive and react much faster than anything else. In 2018, what I recall is that we were having big changes in trade. The markets reacted very poorly. So I recall in the fourth quarter of 2018, the equity market kept declining almost uncontrollably. I think we were down about 20% from the highs that year. And that at that time, in the December FOMC meeting, then in 2018, the Fed was actually penciling in 2 hikes in 2019, but in January they pivoted due to the tightening financial conditions. So applying that to this year, the amount of policy uncertainty is going to have a real impact on the economy and on prices, but the financial markets are much, much more sensitive to this. So they're going to front run all of that. And I think that once the financial conditions tighten, so let's say a continuation of the decline we've seen in the equity markets, the Fed will be much more concerned about employment than inflation. So the U.S. economy, from my perspective, is highly sensitive to financial conditions since a lot of people finance their purchases from their wealth in the equity market. If you have a 10, 20% haircut there, I don't think we'll be worried about inflation, at least for this year. So my expectation for Fed policy is that we're going to have, say, 4 to 6 cuts this year rather than the 2 priced into the market, simply because the equity market financial conditions are going to react much faster than any of the real data.
Yeah. Let me just unpack a few things here because you said quite a few things there. So I just want to also, for anyone listening to this, we're recording this on March 20th. So we're already have seen during this calendar year, a 10% decline in equities markets. If you're in tech stocks, it's closer to 15, depending upon your name. But overall, that was the main driver of the rises in that sector, was the main driver of the rises in the stock market over the last couple of months. And the Fed meeting that Joseph just referenced was yesterday on March 19th, when I would also note that the top line Fed number for growth for the United States was lower. So that's a huge deal. But so you're expecting, so are there other similarities that you see between the current year and 2018?
So I think the disruption this time around when it comes to trade is much greater than it was last time around. Last time we were having tariffs, particularly on China. This time the tariffs on China are already higher than they were before. Right. They're additive, of course, because President Biden also kept a lot of the Trump era tariffs. But this time around, the big reveal was the April 2nd reciprocal tariff date, where President Trump is going to basically charge tariffs on other countries according to what they charge us. But if you look at the language of the executive order, it's actually basically a carte blanche. So what's construed to be tariffs on the U.S. is something as wide as VAT taxes. So there could be there's a lot of leeway for the administration to raise tariffs on other countries. So that could be, I think potentially very disruptive, even more disruptive than 2018. So the correction we've seen in the equity market doesn't surprise me, and it wouldn't surprise me if it continues.
Yeah. Well, I think a lot of people are saying that, particularly because we had the stock markets return 20% the previous 2 calendar years. So, yeah, I've never done that before.
I'd add something else as well. So there are policies that the administration are doing that are going to put downward pressure on growth, even without the trade policies. For example, one of the reasons why we've had above trend growth, say 3% the past few years, is simply because we had a huge influx of migrants.
Right.
Now, growth is basically, just you can have more growth if you have more people working or you become more productive.
Right.
Now, during the Biden administration, based on various reports, we had an influx of several million migrants. And if you have more people working in the U.S. economy, you're going to have more growth. Doesn't mean that we're going to have higher per capita growth. I don't think we do.
Right.
But if as that migration policy adjusts, you're going to have lower growth. Doesn't mean that our per capita growth is going to decline, but the aggregate growth will. And of course, there's an effort to have a bit more constraint on fiscal policy. So again, we had a 6% deficit during the Biden era. That was very, very large. I think historically, as the largest it's ever been outside of wartime in a recession.
Right.
And as those factors fade away, you're going to have more downward pressure on the economy. And I think that's healthy, but it does imply that we could have more cuts than the market is pricing.
Well, let's shift to the debt pile, which is still being talked about by, in my opinion, far surprisingly too few people. So what are the changes that you think are wrought by the more debt that's coming in the short run in the volume of the issuance of bonds?
Well, Rob, you're addressing a very important point right now. The fiscal situation in the United States is simply not sustainable. So our fiscal deficit is about 6%, and that's about $2 trillion a year. Now, looking out into the future, if you look at CBO estimates, it's projected to be about $2 trillion a year forever and continue to grow. But the CBO is constrained in that it has to make estimates based on current law. So it's assuming that the tax cuts expire later in the year. But I think we can say with great confidence that the administration's priority is to make sure that they get renewed. And so the deficit is worse than that. So what does this mean to have a huge, ginormous fiscal deficit? Well, there's good news and bad news here. The good news is that it's impossible for the U.S. to have a fiscal crisis or a debt crisis because we are in a fiat system. At the end of the day, we have the Fed who can print money and buy Treasury securities. This makes our situation not comparable to things in the past when we were under a gold standard, right? If you're under a gold standard, government can't print gold, and so you could potentially default. It also makes it not comparable to, say, a situation across the pond in the Eurozone, whereas the euro is a fiat currency, the individual member states are not monetary sovereigns, so you can have small countries like Greece basically default.
Right.
So at the end of the day, there's not going to be a debt crisis. Now, that's the good news. The bad news is we can have other kinds of crises.
Right.
So if we print a lot of, so let's say the Fed just prints and buys all the treasuries, we could have upward pressure on inflation. We could have a currency crisis where people, say, flee their dollar. Now, doesn't look like that's happening right now, although the gold price could beg to differ. But again, we want to address this fiscal situation. So the way I think about this, there's a supply and demand aspect to this. Just looking at supply, again, the most straightforward way to address this is to just have a smaller fiscal deficit. And that turns out to be something that's very difficult to do. When you break down the fiscal deficit, well, fiscal spending, you can say it's mandatory spending, that's most of it, and that's Social Security, Medicare, and politically that can't be touched. So I think in the past, there were some, I'd say, Republicans who would say that we should cut that, but I don't believe President Trump wants to do that at all. We all understand that that's just political suicide, so that's not going to change. The second aspect is discretionary spending, and that's things like military, things like administrative salaries and so forth, could potentially have some change there. Again, the military spending is difficult because it does seem like we're in an era of more geopolitical instability. And the last piece of the pie, it's about 15% of expenditures, and that's interest payment. And I don't think the U.S. is going to default on their debt, so that can't be changed either, although we could have lower interest rates. So the administration's policy seems to be to try to, again, try to cut waste and fraud. And surprisingly, that is a large chunk of expenditures. Now, it's hard to know just how much there is, but the Government Accountability Office under the Biden administration actually has an estimate that we could have as much as $500 billion a year in outright fraud. And so if we can cut that, that's a chunk out of the 2 trillion deficit. And there is, of course, room for optimization in how the government spends its money. Now, I used to work in the public sector, and you could think of this in terms of incentives, right? At the end of the day, the federal government is a business that can't fail, run by people who can't get fired.
Right.
So
Right.
there is not an incentive to be efficient over there.
Right.
So I think that it is achievable to cut the deficit. I mean, not to zero, but 6% to 3%. I think that's totally doable. So that'll help on the supply side. Another aspect that
Oh, and let me just
Yes.
pause for one second because I just want to clarify a few things for the listeners. So, if you're not familiar with the GAO report that Joseph was just talking about, they did a very good podcast on this way. I believe it was in September or October of last year. GAO's podcast is actually pretty good. Check it out. And just to clarify one other thing, there's been a lot of writing on some of the topics about fiat currency. I think it's also important to note that a lot of economists believe that the other thing that is exceptionally important in the U.S.'s fiat situation is that the U.S. has only issued debt in U.S. dollars, which is the other sort of constraint that they put on it to come up with these things. Sorry.
You're exactly right. Foreign countries issuing in dollars has not turned out well for them. So looking at the supply side of debt again, one other thing that the government has been trying to do is to adjust the tenors of its issuance.
Mhm.
So we saw this happen under the Biden administration. So the U.S. Treasury issues a whole bunch of debt securities, right? You have short-dated things like Treasury bills, all the way up to notes, 30-year bonds. Now, all these are Treasury securities, but they have very different risk profiles. When you're looking at Treasury bills, it's basically just cash that pays interest, right? It's very liquid. There's no interest rate risk. But as you go further out the curve, say into the 30-year sector, a 30-year bond, it's a Treasury. You think of it as, risk-free. But if you look at the Treasury's 30-year bonds issued in 2020,
Right.
they're trading at like 50 cents today, right? That's equity-like risk profile.
Yeah.
It's a very risky asset.
Yeah.
So one way to help the market to digest issuance is to just issue more of this short-dated debt that's easier for the market to digest. And that's basically what happened the past few years. So the U.S. Treasury recently, a few years ago, had some self-imposed guidelines of having about 20% of the outstanding debt, 15 to 20% of the outstanding debt in Treasury bills.
Right.
Now, a couple years ago, as the 10-year yield was crossing 5%, there was kind of a panic in the market, and it seemed partially perhaps to address this, the Treasury began to issue more and more bills proportionately, and that seemed to have a calming impact on the market. And so that made the market, allowed it to more easily digest the tremendous amounts of issuance we have. Now, Secretary Bessent has spoken negatively about this move, but he wants to continue the policy at least until interest rates are lower before shifting the debt mix to something that it's, I think, more in line with the Treasury's own guidelines. So on the supply side, there are some moves that are trying to make this easier for the market to handle.
Well, let's shift a little bit to the bond market overall, because you did touch on a very important thing that's affecting the 30-year, right? But there are also some other interesting things going on. I do have to say hello to all of my former Fitch Ratings coworkers about this. Some of the bond rating agencies came out pretty strongly, or strongly for their language anyway, about the U.S.'s federal debt. And most of them have the U.S. Exceptionally high rating still, even though one notch lower. So the market is responding to a lot of stuff in the once again we talked about in the 30-year. So where else do you see this happening in sort of the markets per se?
Well, if you're talking about looking across the markets, so I think looking into credit, it's a little bit harder to say because there seem to be big structural changes in how that sector of the market is operating. If you look at credit spreads, they're relatively narrow, but you also have the tremendous rise of private credit, for example, so that more and more of that sector is done outside of the capital markets in the shadow banking sector, that it's a bit more opaque.
Right.
So as we have more, I think as that sector becomes a bit more opaque, it's harder to know what actually goes on. With respect to ratings, so like we discussed earlier, the U.S. is, a monetary sovereign. It can always print money to buy it, but it is possible for them to voluntarily default.
Right.
And that was, I think, part of the rationale for S&P's downgrade of debt. So I used to work at S&P Ratings a number of years ago.
Yeah.
So we see this in let's say government shutdowns, debt ceiling episodes, and so forth, right? Let's say that we do have a debt ceiling episode. I don't think it's likely, and there are the Fed has lots of contingency plans for that, but it is possible in theory for Congress to voluntarily default. So there's that there. My sense is that after the downgrade in debt a number of years ago, a lot of the funds rewrote their mandates so that they can buy things that are sovereign debt, even if they're not AAA rated. And so the market impact of any further downgrades, I think, will be pretty muted. I think the market participants widely view that. Yes.
Right. So you're
Credit risk less asset.
right. So I just want to be clear. You're talking about the S&P's downrated of the U.S., which was in 2011.
Once
Am I right
upon a
about
time,
that?
yeah.
Yeah. Okay. So it's long enough ago that I can't remember exactly. Things were a bit different then. Right? So we were still coming out of a massive global recession. So and the rationale for that might have been a little bit different at the time than what the other rating agencies were saying last year. So. Well, let's shift a little bit because you made reference to this earlier, and I do want to get to this. There's some bank regulatory changes coming, and that could impact rates. So how are you reading all that?
So that goes to the demand aspects that are being contemplated to try to make the issuance more digestible. So if you are a sovereign and you're issuing a lot of debt, you would like to find demand for it, right? You don't really want to rely on the central bank that has that it's perception that you are basically becoming a banana republic. Now, if you look through history, one of the common ways that governments drum up demand is through the banking sector. In World War II, most of the assets held in the commercial banking sector were actually U.S. Treasuries. Fast forward to today, it's much, much lower as a percentage of assets. Now, after the great financial crisis, there were new regulations from Basel, such as the liquidity coverage ratio that mandated banks hold more what's called high-quality liquid assets, which comprised Treasury securities. So there is some demand there. But one of the regulations that was also created back then is called the supplementary leverage ratio. And what that is that it constrains the size of a bank's balance sheet regardless of credit risk. So what that is that under the supplementary leverage ratio, a bank would have to hold capital, the same amount of capital against risky, let's say, corporate debt in the same way as it would a credit risk-free Treasury security, right? So in a sense, that doesn't really make sense. And it's been a constraint on the bank's willingness to hold Treasuries and to intermediate in the Treasury market. Now, there's been a lot of discussion about adjusting this, and it seems like we're going to have concrete action on that really soon. At Chair Powell's House testimony recently, he pointedly mentioned twice that there will be SLR adjustments. And just this past week, we had Governor Bowman elevated to the vice chair of supervision role at the Fed. Now, the Fed is not the only banking regulator, but the Trump administration is able to appoint the others in the FDIC and the OCC as well. So there's definitely going to be change there. And by adjusting the SLR, now this could be by adjusting how reserves are treated or how treasuries are treated, you're going to create tremendous capacity for the banking sector to buy treasuries. One way you can clearly see this happening is in the swap spread. So the difference between treasury yields and SOFR swaps. And it's become increasingly less negative. And that's the market pricing in, again, more intermediation capacity, which would put downward pressure on treasury yields, either by the banks buying them themselves or the banks having more capacity to provide repo financing to the hedge fund community to do this.
Right.
So again, there are ways to manage this tremendous amounts of debt we're issuing. Best way, of course, is that we have a healthy fiscal fiscal situation in terms of spending not too much money. But other than that, there are some tricks as well.
Right. And then the other thing that, underpins this, successfully managing this is also just the thing that underpins lots of things in the market, and that's the health of the U.S. consumer and the ability to tax them. So, there are a few consumer numbers flashing a little red. So people listening to the podcast remember 2 weeks ago when we had a Bloomberg analyst on who talked a little bit about the potential weakness in consumer and the impact on entertainment stocks and the issuance of bonds by those companies in everything from rental cars to hotels, et cetera. So, this is going to be an exceptionally interesting year from that perspective, too. I guess the other thing that I'm just wondering about is because you have an excellent view into the function of the regulatory market, I was always never quite clear. Do the states play a bit of a role in that, in the bank regulation also? Or I know that New York for a while had some regulatory stuff, but it wasn't really on the capital constraints.
Well, there are state bank regulators. I'm not as familiar with how they work. So for the larger banks, it's these big regulations that are more constraining on the federal level.
Right, it's OCC and the rest of the gang. So we'll leave it there. So as I said, please do check out fedguy.com where you can see, if you like what Joseph said, you can hear a little bit more about him and check out his book, Central Banking 101.
Thanks, Rob.
Until next time, I'm Rob Rowan, and this has been Compound Insights.